Hello, Dr. learners, and today's lessons will be on the formal and informal sector, which is nothing much, just the difference between the formal and informal. Then we go straight to the accounting concepts, the key concepts that are very important, and they are always asked on in the matching columns, the same as the GAAP principles. These are the GAAP principles, and you have to know from grade 10. They will apply also in 11 and 12. So these one are very important also. So this is our first lesson on grade 10 in this channel. So without wasting any time, let's just go straight to the formal and informal sector. But before we go to the exact content, I just want to make sure emphasize that when they asked these concepts and the GAAP principles, they will be asked in matching column or true or false. So it won't be there won't be a question that say define this. No, they will just give you column A where there is a concept, and column B where there's definitions. So you have to match if this definition matches with this one, right? So let's just go straight to the explanation of these form of these concepts, principles, and the difference between the formal and informal. Right, so first thing first, we have the informal sector. This is very popular if you are from the Kasi. There is small businesses where there are spaza shops, these saska shops decorated outside. So these are the informal sectors because they are not registered. The government doesn't have information about those businesses. So when it comes to the formal sector, these are the registered businesses. It can be a sole trader or sole proprietor. It can be a company or anything, but those one are the formal one because they are registered. They are known. Sometimes the street vendors in informal sector, those businesses are not known, are not registered. So in those businesses, they fall under the informal sector. So when it comes to the informal sector, there is no booking of records. Let's say, for example, your mother is selling chips as a street vendor close to the tax rank, right? So surely he or she doesn't keep the records of his income and expenses, receipts and payments, right? So most of the informal sectors, all of the informal sector businesses doesn't keep records of businesses. E.g., also the puzzle shops, they don't keep records of their receipts and payments. But now when it comes to the formal sector now, because these one are registered businesses, sometimes they can be audited or investigated, so they keep proper bookings of records. So what proper bookings, they may differ regarding what the business has. So proper bookings of or for the following, maybe for the capital, I will explain in the next slide what is a capital. They can keep proper bookings of records of fixed assets. So these are the long-term assets that the business use to generate profit, right? So we have the stock also. They can keep records of stock when they buy goods to sell to the customers, and also income they receive when they sell those goods, the expenses they spend so that they can help to generate income, e.g. electricity. Then they can make profit, so they also keep record of profit. So when it comes to the formal sector, proper booking system of records is maintained. So they are making sure that for every invoice, for every payment and receipt, there is a proper booking where it belongs in these accounts, right? So when it comes to informal sector, most of the times the prices are estimated, because sometimes you can just buy a box of chips, then now you will decide how much you want to sell each of these chips inside, right? So when it comes to an informal sector, most of the prices are estimated. But now when it comes to the formal sector, now they use the invoices, the receipts and the cash book to determine the prices they will charge. So let's say, for example, if you buy goods and trade it, then the invoice, maybe it was 1,000, then that invoice will be the one that is going to be used so that they can use it to determine the prices they will charge to their customers, right? So when it comes to the formal sector, prices are estimated. But now when it comes to the informal, the prices are estimated. So now let's come straight to our second segment of this video, which is the key accounting concept. And after this, that's where we'll describe the GAAP principles. But this formal and informal sector is just the background information before we go to the accounting concept, because these concepts are the one that we are going to explain. But I wanted to make sure that you know how they are coming from, because they are coming from the formal sector businesses, that they are the one that use these accounts to record their accounting records. Let's say, for example, capital owner using his businesses or taking his personal vehicle for deliveries in their businesses. So by doing that, the owner is let's say is investing or is providing his personal things to the business. So by doing that, that owner that is recorded or is recognized as a capital in the business, right? Because it's from the owner. So first thing first, what is a capital? So a capital is a money or asset the owner invested to run or start a business. As I made an example earlier, an owner can take his personal vehicle for use in deliveries. So by doing that, you are taking your personal assets and you are providing for your own business. So that is called a capital in accounting term. But now we also have the fixed assets. So what are the fixed assets? Because we have the assets, but now we also have the fixed or tangible assets. So there are assets that are not fixed. For example, like stock will describe why those assets are not fixed. Income will describe why those assets are not fixed, right? So now when it comes to fixed assets, these are the assets that are tangible. Usually they don't their useful period in the business will be maybe 3 years. Let's say if we bought the vehicle, we know that this vehicle will last for 5 years. So you see, those items we don't bought them with intention of selling them. What we bought them with intention of using them to run the business. So what is exactly the fixed asset? So these are the long-term assets used in the business for to help the business grow and also making the profit, but they are aimed bought for to resell to the customer. So we can't buy them to resell to the customer. I made an example of a building. Let's say, for example, we use this building to manufacture goods, manufacturing clothes and sell to the customers. So we are not going to sell that building, but we are using that building to run our operations, right? Day-to-day operations. So that building is a fixed asset, because the lifetime of that building will be more than a year. So once something has a lifetime that is more than a year, that is a fixed asset, especially if it's a building, vehicle, equipment, machinery, and all those things that are used not to sell to the customers, but they are bought to help the business grow, right? So those are called fixed or tangible assets. And also in your accounting, I think balance sheet, yeah, in return you will do something called the balance sheet and income statement. So in income statement, you will have the depreciation for the machinery and everything. You will know about that. So I just want you to be aware about that before you are taught. And also in your balance sheet or statement of financial position, these fixed assets will need to be recorded, and you must know them, that these are the assets that have a useful life that is more than a year, or they are long-term assets. So they are not bought to resell, they are bought to run the business. As I made an example of a building or a vehicle for deliveries. So let's come to the second concept. So this one I said is the stock, and I said it's not a fixed asset. Why? It is an asset, but it's not a fixed asset. So what is a stock first? Stock or trading stock, you can call it like that, or some people call it inventory. So all of these concepts are allowed in return. So these are the goods that are bought by the business to sell to the customers in order to make profit, right? So that is what the trading stock is. So these are not fixed assets, because their lifetime is less than a year. Because if we buy a stock this year, surely we are going to sell it also in this year. So these one are not fixed assets, but rather they are the current assets, because they are still going to be sold in this year. And by when we sell them, we receive that income. That income will be recorded in a bank. So also bank is also another current assets, because income is an asset, right? So you must know it. That is not that important, but when doing accounting equation, you will need this information. because you will also do accounting equation in trade 10 accounting. So just know what is a trading stock. These are the goods that the business bought to sell to the customers with intention of making profit. So an example here, let's say clothes, in a clothing company, let's say Mr. Price buying clothes to sell to the customers, ordering clothes overseas and just put their brand Mr. Price and sell it to the customer. So that those clothes that are ordered are the trading stock or inventory. Then by doing that, they are selling them to their customers. That's a distribution, right? So we have something that is called, since now we are buying goods to the customers, then that is not a price that we pay. Let's say we are buying goods for the customers. Let's say Mr. Price, what they are doing there, they order goods overseas. This is an example, I'm not sure if they are doing that. So let's say they order goods overseas, then they take those goods and put their logo, which is Mr. Price, and sell it to their wholesalers, which is their shops in towns, right? So when Mr. Price buys goods overseas, so they are not paying a price, but they are paying a cost price. So now you must know exactly what is a cost price, right? As you can see, it is a cost. So what is a cost price? So a cost, this is the cost that the business pays when buying a stock or trading stock, right? So let's say I have an example that I pointed here. You are buying a box of chips, let's say in informal sector, costing 500, and that 500 is the cost price. So you must know a difference between the cost price and the selling price. So now, you are going to buy those goods overseas, but while they are in the business, you will manufacture them by just putting your logo of Mr. Price. Then you would take them to your maybe to your shopping center, your shops in the town, right? Then when they are there, customers will come and buy. When they buy, they will see the price. So when they pay a selling price. So there's something called the selling price now after the cost price, because the cost is the one that is paid by the business, then the customer pays a selling price. So what exactly is a selling price? So this is the price charged by the business to their customers, right? So an example here, so let's say the business is selling that box of chips for 650. Remember that box was bought for 500, right? So now they are selling it with 650. So 650 is the selling price. So now remember, I think in grade 9, I'm not sure in AMS if you did it in grade 9, there's something called the markup. So that is where you will use most of the times in grade 10, because they will not give you the cost price, or they will give you the cost price and not give you the selling price. So you must know how to calculate it if you are given a selling price. So let's say you are not given a cost price, but you are given a selling price, right? So you know that the cost is 100% because it's not added. This one is 100%, but now they are adding a markup so that they can receive a profit. So they increased the cost price to 640 so that they can make a profit. Now they can't buy something with 500 and sell it with 500 again. So you will have, you know, that what you want is always above, fraction, and what you have is below. So it will depend. Maybe they will say the markup is 50. The markup is always that difference. So maybe it's 150. I'm just making an example for you to be aware. So now you want the cost of sales. So the cost of sales are the ones that you don't have, but you know that they are 100%. So if you want to calculate the cost of sales, you will say 100%. Then that means you want 100% and you have 150. So that is what this fraction means. What you want is always above, and what you do, you what you want is always above, and what you have to get what you want is below, right? So this is an example. Surely if you punch this, you won't get this 500. I was just making it an example so that you will be aware that that is what you are going to do this year most of the times, especially in income statement. So let's come to the second, to the another concept, which is the labor cost, right? So this is the money, because there are workers that are working in the business, so we need to pay them. So that money paid to workers is called a labor cost. And there is something that you have to notice. money that is paid by the business is always having that cost, but what they receive is always having price. So you must notice that, you see, there is a labor cost. This is cost price. I said cost price is paid by the business when buying their stock, but now labor cost, this is the money paid by the business to their workers. So you see, selling price, it's a price because we don't pay it. It will be a cost if we were the one that we're going to pay it. So this is the price that we charge to the customers when buying goods to the business, right? So I think you will also see that they can sometimes make it clear for you, even if you forgot what is a what cost price is. But as long as you see cost, you can just think about it, that okay, we are the one, or the business is the one that is paying. So this is an example: 300 paid to workers for wages. So that 300 is a labor cost, and the labor cost or the wages are the expenses. They form part of expenses, but I will explain what expenses are next, or after the incomes, right? So there's something called income. I think you are aware of it. Income is what you receive when you sell something, right? So it's either you have, let's say, make an example. As I said, this money received, money received for selling goods or services. So the two different things: can be a good, can be a service. Remember, a good can be trading stock, but a service, maybe you are doing what I'm doing. Let's say I'm doing tutorials, but now not on YouTube, but personal tutorials. So for the service, you have to pay. So that is the service. So an example here will be someone, maybe a tenant. I receive a rent income from a tenant of 500. So if you don't know, a tenant is someone that is using my flats to stay, let's say renting a room in my flats. So when I'm receiving that 500, that 500 will be an income. But now in accounting terms, we'll say it's a rent income, but it falls under the income, right? So you must know what is income, because uh, you will need to know the concept, and especially these ones: the income and the capital, the expenses. They are the one that you are going to use most of the times. They like to appear in that matching column, right? So let's move to the expenses, because I said something about the expenses and I didn't finish it. So in expense, these are the cost. Remember, guys, I said once we pay as a business, that that changes from that price thing to the cost. So I think that also, when I'm saying cost, you must be aware that we are the one that are going to pay, right? So expenses, these are the cost paid to run the business. They are not the cost paid to sell, because inventory, we're buying goods to sell. But now these are costs paid to run the business. What cost? As I made an example earlier, these wages are the cost that are paid by the business. If they don't pay their workers, that means there is no operation, because no one is going to come to work for nothing, without the intention of receiving a remuneration, right? So by paying them, that means you want to run your business. So these costs are not paid with intention of selling them, let's say, not unlike inventory, but they are the one that will help the business to function. So the example of expenses are the rent. Let's say if now that building we didn't buy as a business, the building that we are using to manufacture our goods, so we have that rent expense. We are renting to someone our building. Water and electricity expense, the water that we use in the work and the electricity that we use, that is an expense. We can't sell that. And we also have the wages and the salaries and wages. So these are also the expenses, because as I said, I spoke about the wages and the salaries, how they are expenses, because there's no operation. If we don't pay our workers, no one is going to come to work, right? So I think when it, or regarding the concepts, we will have the last one, which is the profit, because all of these, they end up making a profit or loss. So what is a profit? Profit is a income less expenses, right? So if you want to calculate profit, you maybe, let's say if income is 5,000, expenses are 3,000, then the profit will be 5,000, which is income, minus the expenses, which is 3,000, then we'll get a profit of 2,000. So if the expenses are more than the incomes, then you will have a loss, not a profit. So you must know that. But they won't ask you to calculate the profit, but they can ask you the definition of profit, or you must know it. They will put it in on matching column, right? So we have something that is very important that you will need from grade 10 until 12 and university, if you will go there, but surely you will. Then, which is GAAP principles. These are the principles that help the accountants to manage the accounting books and know what should be recorded at what period, because some other things in accounting are not material or are not important. Then these principles will help the accountants to know how to record the accounting records, and where to know if these records are important or if are not important, because if they are not important, they will not have, or they will not need, there will be no need for them to disclose their records separately. They can just include them maybe on expenses or income. But now if they are important, now they can have to disclose them separately. So these principles, they are the one that guide the accountants and also give them a guideline on how to record their accounting records, or to keep the accounting books in the right way, right? So we have the first principle, which is the historical cost. As you can see, it's historical cost, as solely we are paying something, right? So this principle states that assets are recorded at their original cost paid when buying them, not the current market price. Because let's say, for example, before we go to the example that I have here, I just thought about something. In 2010, you bought maybe let's say 2020, you bought a car with maybe 2 million, but now there's an inflation. That car, there's an inflation in prices of goods, but now in 2021 we want to sell that car, and there was an inflation, which means the prices increased. So the price of that car in at the store maybe is 3 million right now. So you can see you won't be selling that car with maybe uh, 1.5 million. No, the value of that car, or the current market price of that car, will increase maybe to 2.5 million. So now when you record this car in 20, because this one is 2020 and this one is 2021, so when you record that car in 2021, you won't record it with 2.5 million, but you will record it with 2 million. Why? Because that's what historical cost is saying. They're saying that assets are recorded at their original cost paid when buying them, not the current market price, right? So an example here that I have, yeah, I think is similar to this one. A business buys a vehicle for 1 million in 2022. In 2023, they added a canopy to their van. So now there is a maintenance to that car, so that increased the value of that car. So the maintenance of that canopy, or maybe what they did, they added this canopy, so the vehicle will cost, maybe the canopy will cost 500,000. So the current price now, the current market price will be that 1 million plus the canopy, which is 1,500,000. But now when you record it in trial balance or the balance sheet, you must note that according to historical cost, assets are recorded in their original price paid when buying them. So the cost of this vehicle will be 1 million, and will be recorded as 1 million in the books, not the 1,500,000. Why? Because that's what historical cost is saying, or telling the accountants to do, right? Then we have the second principles, which is prudence, and this one will be very useful when you are going to do the bank reconciliation statement, because that's where we overstate and underestimate the amounts. So these principles states that accountant must not overstate incomes and expenses, and must estimate the possible losses. So let's start with the estimation of the possible losses, because they're saying that accountant must not overstate the incomes and expenses and must estimate the possible losses. So let's say, for example, we have something called a bad debts. A bad debts, these are the people that are not going to pay their debts. Let's say that we have the debtors control, and that debtor now lost their job, so won't be able to pay their debt. So now that debt will move from that debtors control to being a bad debt, and that bad debt is recorded as an expense. So the business record a possible loss of bad debt, maybe let's say 500. So that is an estimated loss. So that is what prudence says. We must we must estimate possible losses. So these losses must be possible. We can't just write anything. Maybe if someone didn't pay in this month and we record that as a possible loss, no, that person can pay in next month. But maybe there was a issue regarding his or her finances in that month, so he or she didn't pay. So we have to estimate the possible losses. And now when it where the first thing they are saying, first segment of this sentence, they are saying that we mustn't overstate or underestimate the incomes or amounts. So let's say, for example, we received a rent income, recording a rent income of 5,230 as 5,320. So that is what it means to overstate an amount. These errors are always occurring, especially when you are doing the bank reconciliation statement, because the bank will send the statement of your incomes and the payments, of receipts and payments. Then your bookkeeper will also reveal his incomes and payments. So that is where you will see if there was an error to our bookkeeper. Maybe when recording income he overstated. You see, these are the errors. Instead of writing 2 here, you write 3. You just interchange the amounts. So that is what prudence is saying. Accountants must not overestimate and underestimate the amounts. So let's come to the third GAAP principles, which is materiality. This one emphasizes the importance of accounts, or important of a certain or specific record. So what they are saying here, they're saying only important information or records that can affect the decisions of the business must be disclosed separately in the financial records. So let's say, for example, there is something called a trial balance, you all know, and there's something called balance sheet that you don't know, you will know in this year. So in a trial balance, there is income, there is expenses, and there are records, or there are amounts that are recorded to expenses. Those amounts are not that, they are not that important, but the one that maybe sometimes can be recorded in the fixed assets in that trial balance, those ones are very important. So let's make an example here. We bought a vehicle costing 1 million and will be recorded in the fixed assets in the trial balance or the balance sheet, because it is important or it is material, right? But now when we goes to the, maybe we bought a stapler of 50 rand and will be recorded in expenses. Why? Because it is not that important, this stapler. So according to materiality, only important information that affect the decisions of the business must be disclosed separately in the records of the business. So that is also very important to know, so that you can know which amounts to record separately and which amounts to be included on expenses or incomes. So we have something that is also called business entity rule. This one is very important, especially what topic is that, the owner, where the owner always take goes for personal use. Also in the bank reconciliation, there will be payments that the business maybe will recognize as payments, while those are not payments, but the owner take goods for personal use. So let's know first what business entity rule is. So business, this is when the this business entity rule principle states that business assets must be treated separately from the owner's assets, right? So that's what they are emphasizing in this principle. So why they are emphasizing these principles? Because in other businesses it happened that owner using business income for maybe to make home groceries, and that will not be recorded as an expense. That is not an expense of the business, but it is these are the drawings. So what are the drawings? Drawings are the goods that are taken by the owner, or anything of the business that is taken by the owner for personal use, and those are the drawings. They decrease the capital. Why they decrease the capital? Because the capital is the owner's it's where the owner invests his assets and money. So it's like an owner's account. You can say that capital, sorry, it's not capital. Capital is the owner's account. So drawings, they decrease the capital, right? So this is very important to note. Business assets must be treated separately from the owner's assets. So an owner can't take the vehicle of the business and do maybe a road trip. No, you can't do that. The business entity rule is against that from the GAAP principles. So the second one before the last one is going concern. As you can see, is going. So you can see we are progressing to the future. So this principle emphasizes that the business will continue, or they are raising a question, if will the business continue operating in the future. So how we can see if the business will continue operating in the future? This is shown when the business maybe buy a vehicle with a useful life of 10 years. Let's say this year you buy a vehicle with a useful life of 10 years, and that vehicle you are planning to use for deliveries. So once we see that maybe the auditors, when they come to audit your business, then they can give them an indication that no, this business is still going to continue operation or operating in future. So that is what going concern is concerned about. Right? So that principle is very important also. And the last one, which is the matching, this is very important also, especially in income statement. That's why you will know which income to record. That is there's something called accounting principles. It is very important to know the matching concept, because if this income is paid for this year, you will include an income is received, I mean to say, you will record it under the incomes. But if it is for next year, that is the income received in advance, then it doesn't form part of the incomes. So we have something called matching in those GAAP principles, and this state that incomes and expenses of this accounting period must be recorded in this accounting period. Right? So I have an example here that I made. Let's say we have an electricity incurred or paid in 2025 must be recorded in the books of 2025, regardless of paid or not. So let's say, for example, we negotiated with the electricity company that we will pay next year, but please provide electricity for us this year. So that electricity is incurred, but it is not paid in 2025. But regardless of whether it is paid or not, that is a cost incurred in 2025. So when doing the income statement in your expenses, this expense will need to be expensed in 2025, because this forms, or according to matching concept, that expense must be recorded in this accounting period, right? So that is what it means when your teachers will emphasize the accounting principles that you must know when doing income statement. But this was just to make these GAAP principles relatable by explaining or by making examples of what you will do during the year. So I think that was all about this video, and the next one will be the question paper based on these concepts. You can click here to watch that one. So thank you for watching. I appreciate it.